of
August 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform pricing.
Look at question 3.
Hello viewer, welcome to Manifested Online Classes. My name is Mr. Kimani. I want us to continue with our revision for advanced financial reporting, and today I want us to look on a question which was tested in November 2017, question number 5. Now that question part A, it highlights 6 examples of unethical behavior by management of business entities which professional accountant should report about. So that question in part A, that is a question for November 2017, question number 5. So in part A, it requires 6 examples of unethical behavior by management of the company, a company which a professional accountant should report. Report. So in that case, the examiner was requiring you highlight basically 6 examples of unethical behaviors which the professional accountant or maybe the auditors in course of the audit, they should actually report in the auditor's report. Now in this particular case, we do have a number of such unethical behaviors. One is what we refer to as the insider trading. Now when talk about what we refer as insider trading, this is an activity, or maybe this is an action by the management of the company to take the advantage of the information which is yet now to be made public, now to the advantage. For example, if at all maybe the management of the company knows that maybe the company will report some loss, once now they announce their financial result now to the members of the public, then the management of the company, or maybe the managers of the company, can actually be able to use that particular information before it is made public to sell the shares of the company, because automatically the moment now the company announce a financial report whereby it will be reporting that it operated at a loss in a given financial year, that automatically will be affecting the market price of the company shares. So therefore, in such a case, the management of the company may try to use that particular information to their advantage. Therefore, the moment now the accountant or maybe the auditor is aware of that, then he can actually be able now to report that in his report. 2 is what we refer as the routing. When talk about what we refer as routing, this entails maybe misappropriation of the company resources, or maybe awarding what we refer as maybe contract or maybe tenders for the management to receive what we refer as the kickbacks, or basically what we refer as incentives, once now they award those particular tenders maybe to certain parties, or maybe to certain individuals. So therefore, once now the individual accountant maybe come across such an activity or unethical behavior, then he need to proceed and report that. Now the other unethical behavior which may be reported by the professional accountant is whereby the management of the company, or maybe the managers in a company, are awarding themselves what we refer as excessive remuneration. So when talk about excessive remuneration, this whereby maybe the managers in a company, or maybe the top management employees in a company, award themselves maybe excessive remuneration, or for example excessive allowances, and maybe to the detriment of the company, which is the other unethical behavior which the professional accountant will need to report. Now the other unethical behavior which may also be reported is what we refer as the golden handshake to non-performing or what we refer as underperforming managers, underperforming managers. Now, in this case, when we talk about what we refer as the golden handshake, this is actually a amount of maybe compensation which may be awarded now to the managers of a company in order now to be able to live if at all maybe they are other performing. So mean that if at all maybe the company engaged a number of employees, that is managers, and maybe those particular managers are not performing, the board or maybe the top management may approve some payment to be made to them so that now they can be able to leave the company simply because they are not performing. Still, that is actually considered to be an ethical behavior, and which now the professional accountant should by the end of the day be able now to report in his report. Now, the other unethical behavior which should also be reported is what we refer as excessive risk taking. Now, in this case, when we talk about what we refer as excessive risk taking, this whereby the managers in a company are to undertake a project which are deemed now to be associated with very high risk, and therefore whenever maybe we have such projects which are undertaken by the management of the company and which are not disclosed now to the employees of the company until maybe something happen in the future, then still that is considered now to be an ethical behavior, and this still need to be reported by the professional accountant at the moment maybe they are to issue the report after the audit. And the other unethical behavior which should also be reported is whereby we have incentives, which are basically awarded to the employees of the company, incentives to the employees of the company, which by the end of the day do not encourage the employees of the company to undertake activities which are deemed now to be of the best interest of the company. Rather, maybe whatever the employees will be doing will actually be done in order to receive those particular incentives, or for them now to be able to qualify for those particular incentives. Still, that is also considered to be an ethical behavior, and which now the professional accountant or maybe the auditor at the end of the audit should actually be able to highlight in his report and be brought now to the attention of the shareholders of the company. So therefore, we do have those as actually some of the unethical behaviors which now the professional accountant or maybe the auditors, if they come across them, they need to report that in their report. Now, in the other part of that particular question, that is part B of the question, which was having two parts. So in Roman 1 of that particular question, it reads, with reference to International Financial Reporting Standards IFRS 8, which governs operating segment, outline for disclosure requirement for a reportable segment. So the question here was asking about the disclosure requirement, the disclosure requirement for a reportable segment, in accordance with IFRS 8, Now, first of all, when talk about what we refer as an operating segment, according to IFRS 8, we say that this is actually a component of an entity which can either be a product of the company or maybe a geographical area from where the company operates from, that is a branch, which one, engage in business activities from which it earn revenue and also incur cost. Two, that the result of that particular component are regularly reviewed by the person in charge of making the decision so that he can be able to know the resources to be allocated to that particular segment, and also discrete financial information about that segment is actually available. So therefore, in this case, when talk about now an operating segment, segment as per IFRS 8, this is actually said to be a component. Is said to be a component of an entity, which number one engage in business activities, business activities, from which number one it earn revenue, and number two it incur cost. Cost. Two is that an operating segment is said to be a component of an entity whose financial results are regularly reviewed by the entity's chief decision maker in order, number one, to know the resources to be allocated to that particular segment, and number two, for him to be able to assess its performance, performance. So mean that in that particular point number two, we are saying that an operating segment is that particular component of an entity whose financial result will actually be regularly reviewed by the person who is in charge of making the decisions in a company. One, for him to be able to know the resources to be allocated to that segment, and number two, for him to be able to assess how that particular segment is actually performing. And number three, we say that an operating segment is a particular component of an entity whose discrete or basically separate financial information is available. So in that particular case, we do have that as the definition of what refers as an operating segment in accordance with IFRS 8. Now, whenever now a company is to prepare what refers as a segment report at the end of the year, which is basically a breakdown of those particular items in what refers as a financial statement of a company, there is now the information which need to be disclosed in respect now to each reportable segment. Now, what we also need to remember here, when we talk about now a reportable segment, we say that this is a segment whose separate information need to be disclosed in the segment report. And basically, for a segment now here to be deemed to be reportable, there are those particular criteria which need to be met by such a segment, or there are those conditions which need to be met by a segment for it to be deemed to be reportable. One is that that particular segment has to meet now the definition of a operating segment as per IFRS 8. Two is that that particular segment, its total revenue, total profit, and also the total asset should be 10% or more of the total asset of the whole company, the total profit of the whole company, and the total revenue of the whole company. So therefore, if now a segment meets that particular definition, then in this particular case we say it is a reportable segment. And therefore, whenever a segment report is to be prepared, then separate information about that segment need to be disclosed. And therefore, what need to be disclosed, or when talk about the disclosure requirement, we are talking of the information which need to be disclosed in respect now to each segment. Now, the disclosure requirement to be made in respect to each segment. One is information about the segment asset. So mean that the assets which are under the control of each segment will need to be disclosed in the segment report. Two is the information about the segment liabilities. The other information which also need to be disclosed in respect now to each segment is a reconciliation of the segment revenue, to segment profit and the segment asset Now, in this case, when we talk about what refers as this reconciliation, in most of the cases, you'll see that the total revenue of all the segment, the total profit of all the segment, and the total asset of all the segment is not the same with the total profit of the whole company, the total revenue of the whole company, the total asset of the whole company. So therefore, once now a segment report has been prepared, a reconciliation will need to be prepared in respect now to revenue, profit, and also asset, whereby we are supposed to reconcile maybe the revenue, the profit, and the asset of the segment with the revenue, profit, and asset of the whole company. Now, the other information which also need to be disclosed in respect to each segment is what refer as the criteria used by an entity, entity to identify a reportable segment, to identify a reportable segment. Remember, what you have said is that for any segment now to be deemed to be reportable, then you have said that there is the criteria which need to be met by that segment. For example, the revenue of that segment has to be 10% or more of the total revenue of the whole company. The profit or loss of that particular segment has to be 10% or more of the total profit of the whole company, or the loss of the whole company. So therefore, in this case, now an entity or maybe the management of the company need to identify the criteria, or to disclose the criteria used by them in terms of identifying what is a reportable segment and what is not a reportable segment. Now, the other information which also need to be disclosed in respect to each segment is the information about segment revenue, both internal and external, So in this case, when we talk about the internal revenue, this also what referred as the intersegmental revenue. Basically, this is the revenue by one segment, or sales by one segment to the other. And also, the segment will need to disclose what referred as external revenue. When we talk about external revenue, this is the revenue which is made to the customers outside the group, or basically the sales by a segment to customers outside the company. So therefore, we do have that as actually some of the information which need to be disclosed as far as now the reportable segment are actually concerned, and that what was required in that particular Roman 2 of question. So we go to part B, Roman 2 of the question. And Roman 2 of that particular question, we are given some information. We are told the following information was obtained from the financial records of Superfood Group for the year ended 31st October 2017. First of all, we have the consolidated income statement of that company, whereby we have sales of goods, service revenue, rental income, and then we have the total revenue. We have the cost of sales, gross profit, other income, selling and distribution, administrative expenses. We have other expenses, operating profit, finance revenue, finance cost, share of associate profit, profit before tax, and then we have tax expense and the profit for the year. And then from there we have the consolidated statement of financial position, whereby you have asset which are broken down into two: non-current asset, current asset, and then we have the liabilities and the equity. And then we have some additional information. Note 1, we are told for management purpose, the business is organized into 5 operating segment: retail, catering, manufacturing, publishing, and others. And then we have details of operating segment as provided there in part A, B, and C. And then we are given note 3, whereby we are given the intersegment profit amounting to 4,223,000. Then the question there requires to prepare a segment report as far as the information provided above allows, according to IFRS 8. So what you are required to do there in Roman 2 of that question is to prepare a segment report. So the first thing we need to have here is the title of the company. The title there is the Superfood Group, and we are required to prepare a segment report. Which is for the year which ended 31st October 2017. 2017. Now, in this particular case, if at all you are given a question whereby we are required to prepare a segment report, what you are supposed, first of all, to remember is that a segment report is part of the notes which accompany the financial statement. And basically, a segment report is prepared to show a breakdown of those particular items in the income statement, is the statement of financial position of the whole company in terms of segment. So therefore, what we should do when preparing a segment report, we should have columns here equivalent to the number of segment. Then we should also have two additional columns. A column for elimination, whereby that column is used in terms of eliminating all the intersegmental transactions, and the consolidated column there, or the total column. Now, if we go back to additional information, note 1, we are told that for the management purpose, the business is organized into 5 operating segments. So mean that in our case, then we will be having 5 operating segments: retail, catering, manufacturing, publishing, and others. And then we should have now additional column for elimination and the consolidated column. So let's have those particular columns here for our reportable segment. We have the first reportable segment being retail. We have catering. We have manufacturing. We have publishing, and then we have others. So those are the 5 reportable segments which we have. Then you have said that other than having columns equivalent to the number of reportable segments, we should have additional column here for elimination. Now this elimination column, I've said that this is used in terms of eliminating what refers as intersegmental transaction. And finally, we should have the consolidated column. We should have the consolidated column there. Then those particular figures which are given there, they are in thousands of shillings. So we need to indicate that our figures are in thousands of shillings. In thousands of shillings, like that. And once now we have that, then what we are supposed to do when preparing our segment report, always we should start by recording the revenue of the segment, of which you have said that a segment may be having both internal revenue and also the external revenue. So therefore, here we record both the external revenue and also the internal revenue. Remember, we have said that this particular internal revenue, it is the revenue by one segment to the other, of which we refer to that as also intersegmental revenue. So that's what we need to record. So if you go back to where we have additional information, note 2. In that case, we have in part A, we have information about the revenue. So first of all, what we are given there, we are given the total revenue, and also we are given the intersegmental revenue. And in a case here, what you need to note is that if now we add these two revenue, the internal and also the external, what we should get here is the total revenue, revenue, of which now in additional information part A, that is additional information note 2 part A, what you are given the total revenue. So like for retail, we are given the total revenue there being 129,842. And still in that case, there in part A of additional information note 2, we also given the internal revenue. So for the first segment there, it was not having internal revenue, or basically intersegmental revenue. And because in our case here, we've said that this is the total revenue, that is a total of external and also internal. If at all we are given this, we can be able to get that. Of which this is 129,842. So mean that because these are total of the two, and in our case we don't have internal there, then meaning that the total revenue there should be external. External. We should have that there. We do the same for the other segment. We have the total revenue, which is 66,853. So, and we are given the internal to be 74,65. So what we need to do in our case is to get now the external revenue, which now the external revenue in our case here will be the difference between the two. So let's compute that. We compute that by taking 66, 853, we less 74, 65. So and that should give us 59, 388, 388. So we proceed now to the other segment. We take the total revenue, which is given as 39, 495. We have the intersegmental revenue or the internal revenue, which is given as 36, 791. So mean that the external revenue there should be the difference between the two. So we take 39, 495 minus 36, 791, and that will give us 2704. And then for the other segment, that is publishing, we are given our total revenue there as 32, 306. The internal revenue is given as 0. So mean that the full amount then is the external revenue. And then finally we do have the other segment. The total there is the total revenue is 5663. Sorry, that should be 37. That should be 37 for 47, and then the internal is given as 5663. So mean that to get that, we should get the difference between the two, just like what you have done in the other segment, 37 447 minus 5663, and that will give us 31 784. So once now we have recorded information about sales, both internal and also external, then what we are supposed to do, we should get now the totals across. And once now we get the total external revenue, that should be taken out to the consolidated column. Remember, we have said that this particular column here, the elimination column, is for eliminating all intersegmental transactions, such that no intersegmental transaction should be taken to the consolidated column. So let first of all we get the total external revenue. So we should have 129, 842 plus 59, 388, 88 plus 2704 plus 32, 306 plus 31, 784. So that should give us a total of 256, 024. And then we get now the total internal or intersegmental revenue. So we have 74, 65 plus 36, 791 plus 56, 63, 56, 63, and that should give us 49, 919. And because now this is internal or intersegmental revenue, then you have said that should be eliminated in the elimination column, such that once now we add across in our consolidated column there, we should be having 0, because I've said that this column is used in terms of eliminating all intersegmental transactions, such that in the consolidated column there, we should exclude all intersegmental transactions. So then we get the total downward here. We should be having negative 49, 919, and then here we should have a total of 256, 020, 024. So that what was required in that first part there, that first part. And what that means is that if at all now we go to the income statement of this particular group, the total revenue which we have in the income statement should actually be the same with what we have there. So if at all we go to the income statement which we have under the first paragraph, we will see that the revenue which is there is 256,024. So that's what we have. Now, once now we have recorded information about revenue, then from there we should proceed and record certain items of income and expenses. For example, here we should proceed and record information about interest income, income, income. Now, if you check on the information which are given here in the additional information from note 1, 2, and 3, we are not given information about interest with income, and that's why in the requirement there, we are required to prepare a segment report as far as the information which are given can allow, can do what? And also mean that in our case, we don't have that particular information about the segment what? The segment interest income. Still, we should also record information about the other incomes, In our case, we don't have that. Still, we should also come here and we record information about the interest expense, or what in other terms we refer to as the interest expense. So in our case, if you check on the information which we have there, we still don't have that. Then finally, we should also record information about depreciation and amortization for each segment. Also, according to the information which we have, in our case, we don't have that. So therefore, once now we have recorded information about total revenue, we should proceed and record these other items of income and expenses, of which in our case there, we don't have that information. Then from there, what we need to do is that we should proceed and record the information about the segment profit, about the segment profit. Now, if you check on the information which we have there, if you go back to note number 2B, you'll see that in that case you're given the segment operating profit. We are given the segment operating profit. So that's what we need to record here, the segment operating profit. In that case, we have the profit for the first segment, which is 68.87. The other segment is 47.16. We also have information about the profit for the other segment, 12.83. We have 11.69, and then we have 32.84. Now, what we need to note is that this particular profit which is reported by each segment, this should include the profit from both the internal and also the external sales. And therefore, once now we are to add across here, in the elimination column, we should eliminate any intersegmental profit, of which when we talk about intersegmental profit, we are talking of the profit reported by either of the segment here from the internal revenue or from the intersegmental revenue. And in our case here, if we go to note number 3, there, you'll see that we are given the intersegmental profit, because I've said that this profit here includes the profit from both external sales and also internal. So what we should do here is to eliminate the intersegmental profit, such that what we shall be having there should only be the profit from the external sale. So let's get the total, and then we eliminate that. We get the total. We have 68.87 plus 47.16 plus 12.83 plus 16, that is 11.69 plus 32.84 minus the intersegmental profit of 42.23, and that should give us 13.1116. So, and what that means is that if at all we go back to the group income statement which we have there, we must be able to see the profit before tax for the whole company is the same as an amount of 13.116. So that what we should record next. And then there are some cases whereby we may be given various items, like what we refer as unallocated incomes. If at all we are given unallocated income, this is the income which has not been identified with a certain segment. So always that should be added now to the our profit there in the consolidated column. Still, if at all we are also given information about unallocated expenses, still we should come and we adjust that in the consolidated column. But in our case, we don't have either unallocated incomes or unallocated expenses. Now, once we have recorded information about the segment profit, then from there we should proceed and we record information about the segment asset, of which in our case we have that information. If we go back to where we have a note 2, additional information note 2 part C, there we are given information about segment asset and liability. So what we need to do is to record that segment asset. The segment asset for the first segment is 50, 152. We have 45, 145, 145, 45. And then we have the other segment. We are given that is 24, 620. And then we have 14, 165. And then we have 23, 829. And then what we need to do is to get now the total. Let's first of all we add all that. We add all that. We have 50, 152 plus 45, 145 plus 24, 620 plus 14, 165 plus 23, 829, and that should give us a total of 157, 911, 157, 911. Now, in the same point, whereby you are given information about segment asset, you'll see that the last item which you are given there is something known as investment in associate. Now, investment in associate, this is what in other terms we refer to as an allocated asset. So, in this case, if you are given assets which are not allocated, basically these are assets which are not identified with a certain what segment, and that now should be added to the total asset in the consolidated what column. So therefore, in our case, the unallocated asset is 764. So we add the two. We add the two. We add 764, and we get 158, 675, 675. Now what we have there is what we refer to as the consolidated asset. The consolidated asset. And what that means is that if now we go back to where we have the group statement of financial position, the total asset should be the same as what we have there. So if you check what we have there as a total asset, it is 158,675, because what we have said is that whatever we have here as a segment asset is basically a breakdown of what we have in the statement of financial position. Then from there, we then proceed and record the information about the segment liabilities. So, and still we have that in additional information note 2 part C. So the liabilities for the first segment is 14, 839. Then we have 9783. We have 3609. We have 4704. We have 34,175. So then what we need to do is to get the total liabilities there. In terms of adding all that, we have 14,839 plus 9783 plus 3609 plus 4704 plus 34,175. That will give us a total of 67,110. Now, in our case here, if we are given still unallocated liabilities, these are then the liabilities not identified with a certain what segment. So those unallocated liabilities should be added now to the total liabilities, or to the total segment what liabilities, of which, according to the information which we have here, in our case we don't have unallocated what liabilities, and basically after adding the two here, we should be able to get now the consolidated. We should be able to get the consolidated liabilities. So mean that in our case, the consolidated liabilities here will be 67,110, 67,110. So therefore, that generally how we present, or how we prepare what we refer to as a segment what report, and that what was required in that particular question there. That brings us now to the end of our today's class, whereby we have managed to look on the preparation of a segment report and various disclosure requirements in respect now to a reportable segment. So thank you for your time. So we continue from there in our next class.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
August 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform. Pricing.
Look at question 3.
Hello and welcome learners. This is lesson 4 of derivative in financial risk management. So in lesson 4 we are going to look at Greeks, but before we start lesson 4, let's do a recap of our lesson 1, 2 and 3. So our topic is derivatives in financial risk management. So in our lesson 1, we defined the term financial risk, and we said that it occurs when there's some instability and losses in the financial market caused by changes in interest rate, currencies, among other factors. Then we looked at risk management, which is monitoring and trying to mitigate the risks that come with financial loss. We looked at different types of risk, and the first risk that we looked at was the operational risk. So we looked at operational risk as the first type of risk. After that, we discussed the fiscal risk, which we say that they come due to changes in the tax, different tax rates. And then number 3, we looked at foreign exchange risk, and we said this occurs due to transactions in different currencies. For example, if you have a loan from a foreign country, or you're trying to expatriate dividends from one country to another, that causes foreign exchange risk. We said there are 3 types of foreign exchange risk. We have translation risk, we have transaction risk, and we have economic risk. So under the foreign exchange risk, we're saying we have the translation risk, and this normally is depicted where we are doing reporting, where we have the functional currency of a subsidiary being converted into the reporting currency of the group. Then secondly, we have transaction risk, whereby we say this arises due to different exchange rates between the transaction date and the settlement date. So we have the transaction date being the point at which you contract or you execute a transaction, but it is settled at a later date, which you are calling the settlement date, and the exchange rate might be different, thereby bringing the risk of transaction risk. And finally, we had the economic risk under the exchange rate risk. The other risk we looked at the regulatory risk, whereby we said that when regimes change, like now after 5 years we do elections. So when regimes change, they can come with different rules. We have different regulatory authorities like the CMA, we have the RBA, that is the Retirement Benefit Authority, and the Capital Market Authority, which regulate different markets. So the regulation in different markets can cause regulatory risk, because it can either favor the business or it can ruin the business. Then we looked at the political risk. This comes about when you have instability in our government. The next, we went ahead and looked at the term structure of interest rate. So we looked at the term structure of interest rates. Or what we call the yield curve. And we discussed the term structure of interest rate, which we are calling the yield curve, and we said it's upward sloping, meaning that as we increase maturity, the interest rate increases, meaning that when you deposit your money in the bank, or when you have a fixed deposit in the bank, you expect that the longer it stays in the bank, the more interest it yields. So that was the normal yield curve. This was maturity, and this is interest rate. So you see, under the normal yield curve, this is what we expect. We expect that as the maturity increases, our interest rate, the yield on the bond or the yield on the deposit, will be high than when we lock our money for a short period of time. We looked at 3 different scenarios, or 3 different types of yield curve that you can have. And the first one was the normal curve. This is when everything is, all factors held constant. This is what an investor would expect to have. The second graph that we discussed was the flat yield curve. And we illustrated in form of a graph. This was maturity and interest rate. We said this graph occurs where we have the investors are uncertain about the movement of interest rate, whether they'll go up or down. So in that confusion or in that uncertainty, that is where we have the graph of a flat yield curve. Then the final graph we discussed was the inverted yield curve. Inverted yield curve. We illustrated the same using a graph. This is interest rate, and you have the maturity. And we discussed and said that this is an abnormal yield curve, or it's the exact opposite of the normal situation of what is expected in the market. It occurs, it's rare to happen. But what it's saying, it depicts is that as maturity increases, the interest rate also goes down. As we can see from here, when we have low maturity, we have high interest. We went ahead in lesson 2 and discussed about derivatives. Our lesson 2 was about derivative and the purpose of derivative. We said that a derivative or derivatives are financial instruments that derive their value from an underlying asset. We discussed different types of derivative. We had the forward contracts, and we said it's a contract between 2 parties whereby the buyer promises to buy an underlying asset in the future at a price set today. Under the forward contracts, we discussed various types of forward contracts. And we said 1, we have equity forwards or equity forward contract. Then we have commodity forwards, interest rates forwards, and commodity. We defined the equity forwards as forward contracts in which the underlying asset is equity. And for the commodity forwards, we say that the underlying asset is commodity. And in that order, for the interest rate, the underlying asset was interest. And for, sorry, there's a repetition here. This should be this commodity, and this is currency forwards. Currency forwards. So under the currency forward, the underlying asset is the currency. Number 2, the second type of the derivative instrument was futures. So we had the futures contract, and the futures contract we defined is as a standardized derivative in which we have two parties. The buyer promises to buy an underlying asset into the future, but the price is fixed at initiation of the contract. And we discussed and said that the difference between a forward contract and a futures contract is that the forward contract is traded over the counter, and we said over the counter is a customized kind of contract whereby two parties come together and agree on the terms to execute in the future without having a standardized market or an exchange traded market. But the futures contract, two parties come together, but they trade in a flow that we call the exchange traded flow. Under the futures contract, we also discussed various types of futures contract, and we said there are 4 types of futures contract. Number 1 was equity futures contract, whereby the underlying was equity. Number 2 was commodity futures contract, whereby the underlying was the commodity. The underlying asset was the commodity. There was interest rate futures contract. For this contract, the underlying is interest rate. And finally, we had the currency futures contract. So futures contract helps us in risk management in that we lock in a price. If it's, for example, the currency futures contract, we are locking in an exchange rate so that we do not suffer a loss into the future if the exchange rate happens to change due to the dynamics of the market. We looked at our third type of derivative, which was swap. So we looked at swap contracts. And we said that a swap contract is an agreement between two parties in which they exchange a series of cash flows. One party pays or exchanges variable series of cash flow given a certain underlying asset, and the other party gives either a variable series of cash flow or a fixed series of cash flow, but based on a different underlying asset. We discussed under the swap contract, we discussed different types of swap contract. We discussed about equity swap, whereby the underlying asset was equity. We also discussed interest rate swaps, in which in this contract the underlying was interest rate. We have commodity swaps, and we also have currency swaps. So under these different types of swap contract, the underlying asset is, for equity swap, the underlying asset was equity. For currency swap, the underlying asset was the currency. And for interest rate and commodity, in that order. Finally, under the derivative instrument, we looked at options. And we said that there are 2 types of options. We looked at options, and we said an option, number 1, an option is a contract between 2 parties in which the buyer, so this is options. We have call option and we have put option. We defined an option as a contract between 2 parties, the buyer and the seller, in which the buyer gives an amount which we call the premium to be able to have the right to either buy or sell an underlying asset into a future date, and the terms are set at the initiation of the contract. We have 2 types of contracts. We have the call option and we have the put option. A call option gives the buyer the right to be able to buy an underlying asset in a future date at predetermined price at initiation of the contract. Then we looked at an example of the same. Then we looked at put option, and a put option gives the buyer of the put option the right to be able to sell an underlying asset in the future at a predetermined price at initiation of the contract. We looked at the purpose of derivatives. The main purpose of derivatives instrument is to mitigate risk, to be able to manage risk. If you look at the forward contract, futures, swap, and option, all of them, we are able to lock in a price today or at initiation of the contract to be able to execute a certain action to either buy or sell in the future, meaning that we are able to hedge or to be able to minimize the risk exposure into the future through our derivative. So that's why we said one purpose of derivative was risk management. The second purpose of derivative was operational advantage. Thirdly, we looked at market efficiency. Market efficiency, and finally we looked at information discovery. These were the four main purposes of why we should have derivatives or derivative market. We went ahead and valued one of the derivative instrument, which was option, using the Black-Scholes method model in our lesson 3. So we looked at valuation of options, and options was one of the types of the derivative instrument, and we are using the Black-Scholes model, what we call the BSM model. We looked at different formulas in valuing the call and the put option, and we looked at how we read different values that are used in the Black-Scholes model in the cumulative probability distribution tables. Today now, in our lesson today, which is our lesson 4 and our final lesson under derivative in financial risk management, we're going to look at Greeks. We're going to look at Greeks, which shows the relationship between the call and put prices, the relationship between the call and put prices and different components in the Black-Scholes model. So in our Black-Scholes model, we noticed that there are different components that we used. Number one, we used our SO, which we were denoting as our asset price. This is the price of the underlying. We refer to it as underlying asset. We had T, which was our time to expiration. We looked at sigma, which was representing volatility. And volatility, we said, is also the standard deviation. The standard deviation is what we are calling the volatility. Then the other thing we looked at was the risk-free rate. So in our today's topic, we are going to look at Greeks, and we're saying that we are looking at the relationship of each of these components that we used in our Black-Scholes model and how they affect the call price and the put price. And we're going to start with the first one. We're going to start with delta. Our first Greek will be delta. Delta describes the relationship between asset price and the option price. So you're saying that delta describes the relationship between asset price and the option price. We have two option prices. We have call price and put price. So in the graphically, for us to show the relationship between, remember we said that a delta shows the relationship between asset price and the option prices. So in the first graph, I'll show how a call, we have a call option and we have put option. So under the call option, we say that they have a positive relationship with the asset price. So as the asset price goes up, the call option price also goes up. So they have a positive relationship. So we illustrate the graph as follows, meaning that this is the call price and this is the asset price or the underlying asset price. So as the asset increases, so does the call option. If you look at that point and this point, assuming this is 1 and this is 2, this is 1 and this is 2. So as we increase the asset price, the call option also increases. So that is the relationship. So the gradient of this graph is our delta, which is showing that the relationship between the asset price and the call option price. Then you look at the put option. The put option, the relationship between the asset price, this being the asset price, and this is the put price or put option price. So in this relationship, we are saying it's a negative kind of relationship, whereby as you increase the asset price, the put option price reduces. And we can illustrate that from the graph. Assuming this is 1 and this is 2, this is 1 and this is 2. You can see when you have the asset price being 1, the put price is high. But as the asset price increases, the put price reduces. So this is a positive relationship for the call, and this is a negative relationship for the put option. So the underlying asset affects the put and the call option differently. I hope that is clear. So we move to the next Greek, which we call the Vega. And Vega relates to the volatility. So Vega measures the sensitivity of option price to changes in volatility of returns on the underlying asset. And I repeat, Vega measures the sensitivity of the option price to changes in volatility of returns on the underlying asset. So again, in our next Greek letter, which is Vega, we're saying that it measures the sensitivity. It measures the sensitivity between the volatility and it's the relationship between how the volatility affects the call and the put option. We find that the volatility, as the volatility increases, both the call option and the put option increases. So the effect of the volatility is the same for both call and put option. I'm going to illustrate this using the graph. So we have here the call option, and graphically this is volatility. This is volatility. This is call price. And what we are saying is that as volatility increases, the volatility of the underlying asset increases, the value of the call also increases. You can see from our graph that as the volatility moves from point A to B, also the call price moves from point A to B. So this is a positive relationship. And this applies also for the put option. When you have a put option, and here we have volatility, and you have the put price. So the graph appears the same as the call option. So we're saying that the effect of volatility affect the option price, be it call or put, in the same way, and it affects it in a positive manner, such that as you increase the volatility, the option price also increases. Next, we are going to look at the third Greek letter, and we are going to look at the rho. The third Greek letter, we refer to it as the rho. So rho measures the sensitivity of option prices to changes in the risk-free rate. And I repeat, it measures the sensitivity of the option price to changes in the risk-free rate. So here we're saying that we are looking at the relationship between the risk-free rate and the option price. So as the risk-free rate changes, as it increases, it affects the call option in a positive manner and the put option in a negative manner. So let's illustrate this using the graph. So we're saying this is for the call option. Remember, when you refer to the option price, it can either be a call option or a put option. So in the call option, this being we're looking at the relationship between the risk-free rate and the option price, which is now, in this case, in this graph, it's call price. And we're saying that as we increase the risk-free rate, the call price also increases. So we have a positive relationship, whereby we are saying that rho shows the relationship or the sensitivity of changes in risk-free rate to the call price. And we're saying as we change the risk-free rate, as we increase the risk-free rate, our call option also increases. Then we look at the put option. So in our put option, they have a negative relationship. This is a graph that represents the put option. This is our risk-free rate, and this is our put price. The rho is the relationship between the risk-free rate and the option price. And we say we have two types of options. We have the call option and the put option. We've said that the call option is affected in a positive way, such that as the risk-free rate increases, the call price also increases. But as the risk-free rate increases, the put option decreases in value. And this is how we represent it graphically. If you look at, for example, we have this point and we have this point. So we are saying as we increase the risk-free rate, you find that the put option, the put price rather, comes down, unlike for the call option, where as you increase the risk-free rate, the call price increases. So that is under the Greek letter rho. So our final Greek letter you're going to look at is theta. We're going to look at our fourth Greek letter, which is the theta. And this shows the relationship between time and the call option. So this is theta. It shows the relationship between time and the option price. So theta measures the sensitivity of the option price to passage in time. It shows, or rather it measures, the sensitivity of the option price to passage of time. Here we're looking at time and the option price, and these are also affected in the same manner. This is time and this is the option price. So when you talk about the Greek letter theta, you're saying that it measures the sensitivity of passage of time to the value of the option price. And you're saying for both put and call option, as the call and put option nears maturity, its value decreases. As you can see from this graph, at the start, the option price was high. Let's assume this is year 1, year 2, year 3, year 4. So as the option nears maturity, the option price decreases, and for both put and call option, it behaves the same. So this is for, assuming this is for call, also for put, it will appear the same manner because they behave or they are affected by time in the same manner. And this is time. So we are drawing this relationship from our previous lesson where we used all these variables in our Black-Scholes model. And now we are trying to show the relationship between our various components in the Black-Scholes model and how they relate or how they affect the put and the call option. Remember, we were valuing the call option in our previous lesson and we had the formulas. So if you can apply the same formula and vary, for example, if you vary the asset price, you vary the time, you vary the volatility, and also the risk-free rate, you will find that they are affected. They affect the call price and the put price in different manner, and that is why what we've illustrated in our example. So as we come to the end of our lesson, which is derivative in financial risk management, we'll find that we've looked at the 4 main Greek letters, or we call them the level 1 Greek letters. We have looked at number 1. We have looked at our delta, which is the relationship between the asset price and the option prices. And we've seen the graphs that depict the same. Then we've looked at time, at the theta, which is time. It shows the relationship between the time decay or passage of time vis-a-vis the call and put option, or rather the option prices. We've gone ahead and discussed the raw, which is the relationship or the sensitivity of changes of risk-free rate to changes in option prices. And we have also done the graph for the same. Then we've looked at volatility, what we are calling the vega. The vega shows the relationship between volatility and the call price. And we have also done graphically the same. There's an easy way of remembering these Greek letters. If you look at every Greek letter that we have discussed, apart from delta, you'll find that for the time, you're calling it theta. So it is time for theta. Then for volatility, we are calling it vega. So you can use the V for volatility for vega. And then for the raw, it's risk-free rate for raw. And this one now, this is a bit different, but this is delta for the asset price. So thank you very much. We've come to the end of lesson 4, and that marks the end of our topic of derivative in financial risk management. Thank you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Mboya Street, Pioneer House, 3rd floor, opposite Fire Station.
August 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform. Pricing.
Look at question 3.
Hello viewer, welcome to today's lesson. I'm your lecturer, John Kabucho. I'm taking you advanced in auditing and assurance. We are doing revision May 2017 and we're in question number 5. This question is going to be completing this particular paper, having covered the other particular lesson in the previous papers or in the previous lessons. I'm going to read the question just like normal procedure. We read the question, then we look at the number of topics that were brought in that question, and then we tackle the question based on what we have covered as well as general experience that we have had in answering this question. Welcome. The question number 5 in May 2017 reads, a newspaper article contains the following. The role of statutory auditors is often misunderstood. In particular, there is confusion over the auditor's responsibilities in respect to fraud and the nature of the assurance provided by an audit. Furthermore, following a number of corporate collapses and the revelation of fraud perpetrated by management, it is the auditors who may be sued for large sums of money. This trend is threatening the future of the auditing profession. The majority of auditors will prefer the current legislation to be changed to enable auditors agree a contractual cap on a liability, that is, limit on the monetary amount which the auditors could pay out in damages required. A. Compare and contrast the responsibilities of auditors and directors of a company in relation to the prevention and detection of fraud. And B. Explain why the statutory audit cannot provide absolute assurance that the financial statements are free from misstatements, whether caused by fraud, error, or other irregularities. C. Discuss in each case 4 arguments for and against changing the legislation to allow auditors to agree on a contractual cap on a liability in respect of the statutory audit. And that's the end of the question with 20 marks. So the first part has 6 marks, the next part B has 6 marks, and part C has 8 marks, total of 20 marks. I would wish to go through the details again, but these details are not those one of application in nature. However, as I had already indicated, we are going to look on the nature of the questions that had been brought. The first question, they say, compare and contrast the responsibilities of auditors and directors of the company in relation to the prevention and detection of errors and frauds. That one, you will find it under the ISA number 240 revised. We call it auditors' responsibilities on errors and frauds. So the first question there, or the first part of the question there is what? Errors and frauds. The second part here, they say, explain why statutory audit cannot provide absolute assurance that the financial statements are free from misstatement. If you have covered the assurance engagement topic clearly, you realize that those points have been provided there. And they say, why can an auditor provide absolute assurance? That is mostly the topic assurance engagement, but I can just go ahead and put the word absolute assurance here. Absolute assurance. The last part of the question, they're talking about auditor's liability. And this is something that I know you have already covered. Remember, in our lessons, we had covered this particular case and we said that auditors' liabilities are classified in 3 categories. We have the liabilities arising from crime or criminal liability, or we have liabilities arising from the law of tort, and liabilities arising from the law of contract. But again, we went further and stated maybe the safeguards of an auditor. And we said when an auditor has maybe those particular liabilities, he can safeguard his interests or his liabilities or maybe those particular problems by, you remember some of the points like insuring or taking an insurance cover or maybe complying with the auditing standards and guidelines. One more point which was provided there was that they're supposed to come up with a liability cap that is going to limit maybe the amount of liability or damages that they are supposed to go ahead and pay if there is any claim against them. And that's what we have now to go ahead and look at. This last part here, if you ask me, the question is about auditor's liability. Auditor's liability. But I can use the word cap in bracket there. So we are going to be looking on these questions, the 3 of them. And again, before I go ahead and look at them, we can truly, or maybe again, go through the details. The details, part 1 says a newspaper article contains the following. The role of statutory auditors is often misunderstood. So remember, in our earlier lesson, we said when the role of an auditor is misunderstood by the users of the financial statement, we call that expectations gap. In particular, there is a confusion over the auditor's responsibility in respect to fraud and the nature of the assurance provided by an auditor. So most people are confusing. Are really auditors supposed to go ahead and detect errors and frauds? And what amount of assurance are they supposed to give us? Is it absolute assurance or reasonable assurance, or are they supposed to give us low-level assurance? Furthermore, following a number of corporate collapses and the revelations of fraud perpetrated by the management, it is the auditors who may be sued for large sums of money. You have heard that most companies, after they collapse, the 2 people who have maybe to be identified for lawsuits are one, the directors, and the other ones are the auditors. Mostly the auditors are the one who are looked at because they are said to be the watchdog, and therefore they are going to be required to compensate the companies a lot of money. That's why they are having so many crises in this case there. This trend is threatening the future of the auditing profession. When they bring the word trend, automatically they bring the case of emerging issues and trends, and therefore the trend is that because the auditors are facing this particular problem each and every day, automatically the trend, or the trend is that the profession in auditing is coming to an end. The majority of auditors will prefer the current legislation to be changed to enable the auditors agree on contractual cap on liability. Most of the auditors feel that even though they are supposed to go ahead and pay damages or to compensate the client, they are supposed to have a limit of that particular damage, and that's what they are calling here as a contractual cap. So what I'm going to do here, based on question number 1, which reads, or question part A, which reads, compare and contrast the responsibilities of auditors and directors of the company in relation to the prevention and the detection of the fraud. I'm going to draw this diagram here, a simple diagram that will go ahead and identify the responsibilities of the management and the responsibilities of the auditors as far as errors and frauds is concerned. So here I'm going to put responsibilities. Responsibilities on frauds. Here we put what? The management or the directors. Directors and management. Directors and management. Here we put auditors. Responsibilities on errors and frauds, or frauds in this case. There. If you have to go ahead and answer this question, do not be confused by the word compare and contrast, because most people say now that they are using the word compare and contrast, does it mean that they are asking for comparisons and maybe similarity and differences? No. Compare and contrast is just differences, pure differences, and that's what you're supposed to provide to this particular examiner. So, policy number 1, or point number 1 will be the management, the directors and management. The directors have the primary responsibility on prevention and detection of frauds. Prevention and detection of frauds. Remember, the examiner here is concentrating with the frauds. If you read that question again, you realize that the examiner is saying compare and contrast the responsibilities of auditors and directors of a company in relation to the prevention and detection of fraud. So the examiner does not want you to go ahead and provide issues relating to errors. He just wants you to go ahead and provide issues relating to what? Relating to frauds alone. So if you state this one, in most cases we say we go ahead and give the reason why the directors and management have that particular responsibility. But you can say they have a stewardship role to run the company. And again, you can say they are the managers of the company. You can say they are the people who are supposed to safeguard the company's assets. If you can go ahead and provide the reasons, that will be okay. So you can say number 2, because they are the managers of the company, managers of the company, or you can say they control the resources of the company and the asset of the company. Control company's assets. That's another point. And you can also go ahead and say that this management of the company are supposed to prepare. They prepare financial statement. They prepare financial statements. Because you want to scoop all the points in this question, perhaps the next thing you can tell the examiner is how to discharge that responsibility. How to discharge that responsibility. How to discharge that responsibility. It is very easy if you are a director of the company to control errors and frauds. Number 1, you introduce internal control system. Introduce internal control system. Apart from that one, we can say you can introduce an internal audit department as well as internal compliance department. Introduce internal audit department. Internal audit. I think that will give you full marks. However, before you do this question, you need to understand the responsibilities of the directors as far as errors and frauds are concerned, why they have that responsibilities, and get us at least maybe 5 or 10 points which will tell you maybe how they can discharge that responsibility. That has been discussed in your topics in the previous lessons. Then we have what we refer to as auditors' responsibilities. The point number one that you tell the manager, the examiner, is that auditors do not have a responsibility on prevention and detection of frauds, on prevention and detection of frauds. That we remove completely from the auditor's responsibility. Then you can also go ahead and say that auditors have a responsibility to plan and perform their audit in a way that they are going to detect all material misstatement in the financial statement. Auditors' responsibility is to plan and perform audit in order to detect material misstatements arising from frauds. Misstatement arising from frauds. You can also go ahead and say that auditors have a responsibility to report on errors and frauds that they come across or that they suspect or detect in the company. Responsibility to report to management on errors and frauds or on frauds detected by them. We can also go ahead and say that auditors can perform their work with an attitude of professional skepticism, recognizing that there is possible misstatement in the financial statement. Perform the audit with an attitude of professional skepticism. Audit with an attitude of professional skepticism. Professional skepticism. Recognizing that errors and frauds are likely in that organization. And that is how you discuss the auditor's responsibility. So the auditors, we say they do not have any responsibility. They are supposed to plan and perform the audit work to detect material misstatement. They are supposed to report any fraud or error that come across them, or they're supposed to go ahead and perform their work with an attitude of professional skepticism, recognizing that the financial statement could be materially misstated, notwithstanding the management integrity or the previous relationship. I'm deleting this one so that I can introduce question number 5B. And this question number 5B is just about assurance. It's just about assurance. When you are providing assurance based on the topic assurance engagement, there are two forms of assurance that we give. One is either a high-level assurance or a low-level assurance. But assurance is assessed in form of levels. We say assurance can either be high or can be low. But still, assurance can either be absolute or can be reasonable. So there are several forms or several levels of assurance. So assurance is just like a level. If you remember this diagram from maybe the previous lessons that we had covered, we will know that we have a level here. We can call this one low level. Or we can just use the word moderate level. And this one, we can call it low level. This one here, we call it medium level. This one here, we call it reasonable level. This one here, we call it absolute assurance. Absolute assurance. So if you're giving assurance and you're performing what we refer to as limited assurance, you give that type of assurance, a low-level assurance. If you're giving assurance and you're conducting an audit, you provide An audit, you provide what? You provide a reasonable assurance, not a high-level assurance. So the question that we ask ourselves is why reasonable assurance is less than absolute assurance. That one is going to help us answer this question without any difficulty. So the question reads, explain why statutory audit cannot provide absolute assurance that the financial statements are free from misstatement, whether caused by fraud, error, or other irregularities. I'm going to put the words here. Why absolute assurance is not, excuse me, is not possible. Why absolute assurance is not possible. Remember, when we are doing auditing, we use our personal judgment. And our personal judgment cannot guarantee 100% assurance. And that's one of the reasons that we perform in auditing. So we say the use of professional judgment. Professional judgment cannot guarantee absolute assurance. Absolute assurance. In auditing, we say that whenever we collect evidence that is persuasive rather than conclusive. We don't go for 100% assurance or maybe information. We go for evidence that is persuasive. And that becomes another point here. Evidence collected by auditors, evidence gathered is persuasive and not conclusive, and not conclusive. And that becomes another particular point. In auditing, if you remember very well, we say we do sampling. We collect evidence by selecting a few, examining those few, and forming an opinion based on those few. That's also referred to as selective testing or maybe use of sampling. So we can put point number 3 here. We say the use of selective testing, or what we refer to as sampling does not guarantee what? Sampling does not guarantee 100% assurance or absolute assurance. Absolute assurance. And in auditing, we have so many items that are technical in nature. We say they are complex. For that case, because of their nature or because of their feature. And so we say, number 4, it is because of the characteristics of the subject matter. Characteristics of the subject matter. So you'll find that certain items, for example, when you're auditing closing stock, work in progress, things that maybe relates to, they require the work of an expert, we may not be able to go ahead and provide 100% assurance because of their nature. And that becomes another major problem. In auditing, we also say that because the auditor may rely on the internal control system, he may be exposed to what we refer to as inherent limitations on the internal control system, and that will also affect maybe his work, and therefore we can say he cannot perform or provide 100% assurance. So we say inherent limitations on internal control system. Internal control system. There. We can also go ahead and provide other issues. For example, the fact that the auditor is going to be using maybe his knowledge, or he's going to be auditing even future items or items measured at fair value. We can provide number 6 here because the point is 6. The fact that most items in the financial statement, most items are measured at fair value. Measured at fair value. And therefore they are subjective in nature, meaning that the auditor cannot be able to go ahead and provide 100% assurance concerning them. So those are my 6 points relating to why in auditing or when you are conducting statutory audit, we cannot provide absolute assurance. The only assurance we can give is reasonable assurance. So auditor cannot give 100% assurance they can only give reasonable assurance. And having covered that one, then now we bring to the end the last part of the question. The last part of the question is about the capping. In this capping here, we need to know exactly what is the advantages of that particular capping. But again, remember very well, there are several capping, especially in this country, Kenya, we have a number of capping because even fuel is capped. That means there is a price that is limited for any particular product that you sell of fuel or maybe energy in nature. There is also capping of other items like the bank interest rate. There is capping. We cannot go beyond that particular amount. And so I know now you understand what capping means, that we are limiting the liability to a particular level. So whenever we go to the court or whenever we are resolving a particular court order, then automatically we can go ahead and discuss about that capping. So what the auditors in this question are requesting, they're requesting why don't we be allowed to cap our liability so that we don't go ahead maybe and pay more liabilities and maybe close maybe our audit firms. And this statement says, I'm going to read it, the part C of that question, discuss in each case 4 arguments for and against changing the legislation to allow auditors to agree on the contractual cap on liability in respect of the statutory audit. So I'm going to draw a diagram here which is going to show on one side maybe the arguments against and the other side the arguments for that particular capping. Let me delete this part. I hope you have captured that part in your revision book if you have one. And this time we're looking about capping. For the last 3 sittings, you'll find that the examiner has concentrated with the liabilities capping, especially on question number 5. And therefore it is good you understand this capping. So when we cap, we put a limit of the liabilities that maybe an auditor is supposed to go ahead and make. We call this one contractual capping. Contractual cap on liability. Contractual cap on liability. Contractual cap, which means what? That we have a contract and that contract has a term or has a provision that is limiting the amount of liability that we can pay in form of damages to a client. So we can agree that in case of this particular kind of a mistake, let's pay 300,000 and that is going to be all, instead of paying 5 million, 20 million or 100 million. So when we do the capping, there is what we call arguments in favor, arguments for, and then we have what we call arguments against. Arguments against. Let's try. First of all, ask yourself, where did we cover this particular topic of contractual cap? We were discussing about minimizing auditors' liability. And we said one way of minimizing auditors' liability is by establishing a contractual cap for the auditors so they don't go ahead maybe and pay a lot of damages. So we say to minimize, it reduces auditors' liability. Auditor's liability. So one way of safeguarding the auditor is by coming up with what we refer to as contractual cap. A contractual cap will help the auditors to make sure that they don't pay so much and therefore their liability is going to be limited. That's one of the advantages. When we introduce cap, again, what you need to know is that there is continuity of the audit firm. Remember, most of the auditors are fearing, and especially based on that particular note, that most of the auditors will be fearing that if they continue maybe paying huge liabilities or maybe huge damages, they may not be able to go ahead and continue in that particular case. And then most of the audit firms will go ahead maybe and diminish or maybe replenish. So what we want here to do is that we want to protect those particular audit firms, and therefore it ensures continuity, of audit firms. So when we go ahead and do what? We pay damages to a particular amount. If someone tells you the only amount of damages that I can pay you is 300,000, then we are going to do to minimize maybe that particular problem of lack of continuity. So we are going to be having so many audit firms continuing, and that is going to help most of the audit firms. Again, we are going to be minimizing the cost. The cost, we refer to them as legal costs. If you go to and hire a lawyer, then you go to the court and maybe you are paid, you are asked to pay some damages or fines or court fines, then there is so many problems that are associated with that one. So what happens when we introduce a liability cap in the contract, it means in case of that negligence, or in case of a particular liability, we don't have to go to the courts. And so those particular costs associated with maybe a particular cases are eliminated. And therefore we say it eliminates legal costs associated with the liabilities, legal costs, all fees, and therefore reduction in cost of audit. There is reduction in cost of audit. Whenever we introduce a cap, automatically we are making most of the audit firms to introduce a lot of quality, and most of the audit firms will compete based on quality, because now you don't have to go ahead and fear that your audit firm is going to be eliminated. Therefore, most of the audit firms will emerge, and they are going maybe to operate without any particular fear of being eliminated. And that is also going to be eliminating those particular litigations. So you say it promotes small audit firms to have big clients. So it promotes competitiveness, because you cannot now compete with because of your muscles of the resources that you have. And therefore, I can put that one here in bracket, promotes competitiveness. Promotes competitiveness. So most of the audit firms will be able to compete with big audit firms. This is because those big firms are paying the same damages as you, and therefore there is no way you can go ahead and say that because they have more money, then they are going to operate more than you. You people, all of you, you'll have maybe similar characteristics, and you're going to be paying similar amount of damages, and therefore nobody can pay more damages than the other, which is going to be helping those small audit firms maybe to operate, or maybe to continue having a good structure or base. We can also go ahead and say it makes the small audit firms to understand the clients and to avoid that particular liability. Because you know you're going to be sued, then it is going to help you understand that particular client, and maybe to make sure that the liability maybe moves to the directors. So we can say it reduces auditors or transfers major auditors' liabilities to the directors. Transfers auditors' liabilities to directors. Transfers auditors' liabilities to directors. This is what I mean. If the directors knows that the auditor is going to pay a very small amount of money as damages, so what they are going to do, they are going to be very careful in whatever they are going to be doing. And therefore, it's going to make sure that for them, the work of the auditor is going to be eliminated, or to be limited. It is them who is going to be having the major liability on that particular case. But someone will go ahead and say, if you give the auditors a small amount of, or a limit whereby they cannot be able to pay beyond that amount, then they are going to be more negligence, and that is going to compromise the auditors' quality of work. Compromising or compromises auditors' quality of work. This one means because the auditor knows that I'm going to pay a small amount of money, then he can be able to do a substandard work. He doesn't have to follow the laws. He knows he's going to pay a smaller fee, and that's going to help him maybe continue in that particular case there. When we introduce a cap, again, we are trying to eliminate the legal framework, the set legal framework. Because most of the contractual cap is an agreement between the client and the third party and the auditor. The auditors and the client, they agree on maybe the cap that they're supposed to go ahead and put on one another. So what exactly happens is that now you are going to eliminate a lot of fairness and justice within the audit firms and the clients. Either one of them is going to be maybe one of them is going to lose a lot of resources, because in case you agree out of the court out of the court and the court was the arbitrator, then there is one person who has more muscles or has more power than the other one and can go ahead and misappropriate the resources of the other. Again, there is also cases of losses of reputation to the audit field, because now most of the audit firms are going to be providing low or poor quality work. Then there is loss of reputation or good image of the audit firms, You'll find that because most of the people now are going to be compensating, you just know, I'm going to pay this guy this amount of money, so I don't have to care. And because we are going to be losing a lot of work based on the poor quality, then it means we are going to be losing our reputation and we are going to have maybe no good auditors in the field. Again, what happens in this case is that most of the auditors will be exposure of the audit firms to many litigations arising from simple mistakes. So most of the auditors believe that, or they'll know that, or most of the clients, they know they will be compensated by the auditor in case they go ahead maybe and tell the auditor you did something that was not supposed to be done. And therefore, most of the audit firms will be exposed, which is going to introduce a lot of problems also to that particular area. And if you continue harassing auditors, that this time you have to ask them for money, and remember the court, sometimes the court may not find negligence on the auditor, there is going to be possible mass exodus in the audit firms. Most of the audit firms will not continue, and most of them will leave that particular area because of the problem they're experiencing. So we call that one mass exodus by audit firms and clients. So if a client knows very well that you're going to compensate him a very small amount of money, what do you think he's going to do? He's going to leave that audit firm, and he's going maybe to say, I don't need to work with this audit firm because in case maybe he performs a poor work or maybe substandard work, I'm the one who is going to be losing more. So there is going to be mass exodus by some of the audit firms will be out of the market, and some of the clients will also be out of the market because of those particular crises. So those are some of the issues that are associated with that particular case of what? Of capping. Capping is a good thing. However, it has to be tested, or maybe it has to be measured whether it's going to work or not, because it has some advantages and disadvantages. In most cases, we say it has disadvantages because auditors will stop caring so much about the client because they know they cannot pay beyond a particular amount of money. A good thing is that it is going to be reducing the auditor's cost as the auditors and the auditor's liability, because the auditor's liability cannot go beyond a particular level. And therefore, even if it was to be introduced in the profession, then it has to be introduced with certain particular limits or maybe certain particular areas where it is open, meaning we cannot cap certain particular negligence and we can cap certain particular negligence. So for me, according maybe to the current trend, I would prefer that certain areas we cap and certain areas we don't cap, so that we can maybe be able to go ahead and control each and every particular area or profession. I'm done with this particular 2017 May, and I hope you have seen the questions were not very difficult. Most of the questions were application questions, which means that's the difference between auditing and assurance and advanced auditing and assurance. If you can be able to tackle application question and identify the details that the examiner wants you to bring, together with your creativity and innovativeness, then there is no question that is going to be difficult for you. With that, together with maybe your prayers and maybe hard work, you're going to pass, and I hope that you're going to pass with good grades, and I wish you all the best in everything that you are doing. All the best, and God bless.
August 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform. Pricing.
Look at question 3.
Greetings and welcome to our today's class. we want to talk about the common Excel shortcuts that are used so that your functionality can be enhanced. There are so many shortcuts that are used in computers. There are shortcuts that can help you in formatting. We have shortcuts that are general. That means that they can be used in any other package. And we also have those keyboard shortcuts that are uniquely applied to Microsoft Excel. Welcome, and I hope you will enjoy this particular lesson. So we will categorize our formulas into the following categories. First, I've opened a summary of something which I've done here, and I'll create a new worksheet so that I can summarize my Excel shortcuts. So I'll rename the worksheet to be Excel shortcuts. This will be Excel shortcuts in that particular way. I'm going to categorize my shortcuts into the following. First, I'll be talking about the general shortcuts. And under the general shortcuts, we'll have a few that we'll be talking about. For instance, there is F1 as a shortcut. There is a shortcut for CTRL plus Z. What does that do? We have a shortcut for CTRL plus Y. That's also another shortcut, plus so many other shortcuts. So we are going to write them down or have them as we proceed. So one of the commonly used shortcuts in Microsoft Excel is F1. F1 is used when you want to open the help window. So if you want to open or to seek help from Microsoft, you are going to use the F1 key or the function key, which is indicated with F1. At the top of your keyboard, we have functional keys. Functional keys range from F1 all the way to F12. From F1 all the way to F12. Now, each of those functional keys will be performing different functions depending on the program that you are running. So those functional keys will be performing different tasks or different functions depending with the program that you are currently working on. Now, F1 in Excel, just like in any other Windows software, F1 will open the help window. So I'm going to press F1 on the keyboard. If you press F1 on the keyboard, you can see that on the right side, there is the help window that pops up. Here they are saying that something went wrong. They want us to be connected to the internet so that we can explore more about help. So F1 opens the help window. There's also another shortcut, which is F2. What about F2? So let me have it here, F2. F2 will make the cell to be active so that you can edit it. So F2 makes the cell to be active so that you can edit it. For instance, assuming that in cell C3 I have that particular number like that, and I want to edit it. Remember, it is not in edit mode. So if you want to edit or add anything, you can just press F2. F2 will take your cursor to the end of your cell so that you can edit it. So I'll press F2. If you press F2, you can see the cursor becomes active in that particular cell. So again, I'll repeat. If you click here and you press F2, you can see that you have that cursor blinking, ready for you to be able to add something. I can decide to add 0. You can see F2 makes the cell to be active so that you can be able to edit it. We also have F5. I can also come up with another functional key, F5. What does F5 do in Excel? F5, if pressed, displays the edit or the edit dialog box. You will see the edit dialog box. So if I press F5 on my keyboard, let's say F5, you can see the go to dialog box that appears here, go to. So again, if you press F5, you will see go to dialog box. Again, we have F4, which I'm forgetting to include. So we have F4. Now F4 in Excel helps you if you want to insert the $ both before the column and the row headings when you're doing or working with the formulas. So assuming that you have discount, or let me use VAT, you have VAT and your VAT, let's say, is 16%. Then we have the price, not price. We have below here, you have product, and maybe you have soap as one of your products. Soap, you have banana, you have sugar, and alongside that you have their prices, and you want to calculate VAT amount. Remember, the other one is VAT rate. We are doing the VAT amount. Supposing that you want to calculate the VAT amount, then let's see how does that particular function, that is F4, become helpful. Remember, I told you that F4 helps you in inserting the $ both before the column and the row heading. If you do that, it means that you'll be applying absolute cell referencing in your computation. Now, before we proceed, let me, I'll make sure that these ones are well visible. I'll increase the visibility so that it is quite visible to all of us. The visibility is now enhanced. I can as well make this one bold, and I can merge, or maybe before I do that, I could also change the font color so that it looks different, and a few other things that can be able to be done. If you want to make it bold, of course, you can just make it bold like that. If you want these ones to be bold as well, you can also be able to make them bold. I also want to center this. Of course, I'll merge and center so that it is at the center of our work there. So you can see quite a number of things that you can be able to do with your computer. I now want to compute VAT, of course, VAT amount, where we know very well that VAT amount is equal to VAT rate. You multiply with the price. You multiply with the price. So this is the formula that we want to use. If I can make this one a bit visible, you can see that VAT amount is equal to VAT rate times the price. Now, normally multiplying requires that you, or any computation in Excel requires that you precede that with an equal sign. So that will be an equal sign. Or before I do that, I had not brought the prices. Let me bring the prices. I can bring another price, then I can also bring another price like that. So those are the prices. Now I want to get the VAT amount. Of course, that will be the equal sign. Then this times this, of course, this times this. So if you don't use that, assuming that you don't use the $signs, the answer will be a bit different like that. The correct answer is, but if you copy this down, it will be wrong. The rest will not give you the correct values. We'll be doing the absolute cell referencing items later, but for now, if you want this to be referenced or to have absolute cell referencing, or for it to remain fixed, it means you can use the F5. So you click on it, then F5, you press F4, I mean F4. So if I press F4, you can see my cell now has the $sign both before the column and the row headings. I can repeat, so I'll delete that. Again, click on 16, then go to the keyboard and press F4. F4. So the F4 that I'm talking about is this one here, the F4. Once you do the F4, you can see that there is the $sign both before the column and the row headings. The purpose of this is to make sure that whatever is being multiplied will keep referring to 16%, even if you drag this particular formula down. So that can be seen in this particular way. If you now copy down, all your answers are correct. So it means this one keeps taking the price times the VAT. And the last one as well, it takes the price times the VAT. So that's what you'll be using. Those are some of the things that we'll be doing using the F4 keyboard shortcut in Excel. Now another very, very important keyboard shortcut that I want us to talk about is that's another functional keys. Remember, the functional keys are 12. We are not going to look at all of them. So far we've done F1, we've done F2, we've done F4, we've done F5. Let's see, what about F7? I could also introduce F7, maybe F7, F7. I could grow this, that it's bigger. Again, that is F7. Now F7 displays the certain tools such as spelling and dialogue. So if you just press on F7, so F7 will display spelling and dialogue. We'll be looking at that later. There are other particular shortcuts that I want us to look at. Apart from that, let us move to this one. This is CTRL plus Z. What does, or before we go to CTRL plus Z, let me add others. We have CTRL plus A, CTRL plus A. We have another one here, CTRL, control, that is control key, plus C. What does that do? We have CTRL plus X. What does that one do? CTRL plus X. We also have CTRL plus P. What does that particular keyboard shortcut do? Now let us start with CTRL A. See, Control plus A, if you hold down the Control key on the keyboard with A, that particular keyboard shortcut selects your entire worksheet, the contents of your entire worksheet. So I'm going to do that. CTRL, that is the Control key, together with the A down. So CTRL plus A selects everything, as you can see here. Again, I'll repeat, CTRL plus A selects everything. Again, CTRL plus A selects everything. Now that is the same thing as just clicking on the triangle up here. If you click on this triangle, like something just above 1, it also selects everything. So if you want to avoid using your mouse and just use the keyboard shortcut, you can be able to use CTRL and A. So that is CTRL and A. It selects all. You can also be able to use another very important aspect, which is CTRL plus C. CTRL plus C or Control C, this one is for copying. So Control C is for copying. Control C is for copying. So assuming I want to copy this, remember I've selected using the mouse. So you select using the mouse like that. Then you want to copy, it means CTRL plus C. You can see CTRL and C gives you this particular dimension. Or you can use the mouse, which is a long cut, and just select copy. It gives you that. But if you want to make it even faster, you will just use CTRL plus C, which gives you this, CTRL plus C. So that one is copied. CTRL plus V, I'm forgetting CTRL plus V here. CTRL plus V, CTRL plus V, that one is for pasting. CTRL plus V pastes. Now assuming that you have copied, you've selected, you've copied, so it's copied, and you want to paste here, so you can just use CTRL plus V. So I'm going to use CTRL plus V to do that. So you can see what you've copied has been pasted in this new location. So this is CTRL plus V, that is pasting. Pasting refers to placing whatever you had copied or whatever you had cut to a whole new destination. Now what if you are using now CTRL plus X? CTRL plus X is used for cutting. That is Control plus X. This one is for cutting. Let us see how I might need to cut this. So I'll select, let me click outside. and maybe use this. Then I select. Now CTRL and X. CTRL and X. That is CTRL and X. That one cuts. So I want to paste here. I want to paste here. So I'll just say now to paste is CTRL and V. So remember, it removes the contents here and takes them to a new location. So I'll undo. Maybe you want to cut just below them. You can just do CTRL and V. That one is to paste now. So you've cut and you've pasted. You can again maybe undo and do it again. CTRL. I'll select again. Then CTRL and X. That is cut. CTRL and X is to cut. Then I'll move them, let's say even to a new worksheet here. Then I want to paste them here now, CTRL and V, so they come here. The other part is just to extend the column width and also the row height so that everything is fine like that. I'll go back to my worksheet, which was Excel formulas here, Excel shortcuts, and you can be able to see whatever we've cut is now not in this particular worksheet. So that is Control and X, which is used for cutting. Now the other very important aspects of those general shortcuts is CTRL plus Z. CTRL plus Z is used for undoing, that is to undo. To undo simply means to repeat or undo whatever you had done earlier. So assuming you don't want to use this, remember this one is undo. Undo here. You can just click on it, or this one, or instead of going all that long, you can just be able to use CTRL plus Z. So you can see CTRL plus Z. It's like you are going back. CTRL plus Z goes back the steps that you are doing. So everything that you are doing is now being reversed, and already you can see that CTRL and Z, CTRL and Z, CTRL and Z and is used to undo whichever actions that you had done earlier. We also have CTRL and Y. CTRL and Y is to redo your last action. If you want to redo, remember there's a difference between undo and redo. Apart from using these particular arrows here, undo, redo, undo, redo, you can just hold down Control and Y. So I am going to do that. Control Y, Control Y, Control Y, Control Y, Control Y, Control Y. Again, Control Y. Now that one is to redo our previous action. Remember, apart from using the shortcuts, you can be able to use the arrows that are visible at the top left side. This is the quick access toolbar that you can be able to use to access those things as well. And in the quick access toolbar, there is undo and there is redo. And together with the keyboard shortcuts, of course, CTRL plus Y. And again, you can see here, CTRL plus Z. Now, those are very important formulas or shortcuts. Apart from those ones, we want to add a few other shortcuts that are commonly used in Excel. I want to talk about CTRL plus N. What does CTRL plus N do? CTRL plus N. So CTRL plus N creates a new workbook. So CTRL plus N creates a new workbook. Now, to create a new workbook, maybe the normal way without using a keyboard shortcut will require you to click on File, then New. So if you click on File here, then New, you'll be able to have an opportunity to create a new workbook. What if you don't want to do all that? If you don't want to do all that and you just want to apply the keyboard shortcut here, so it means you will hold down Control and N. So we are on a new workbook. Remember, this one is book 1 now. If you want to do another one, is Control and N. Again, you create a new workbook. So instead of, let me close this one. I'll close that, and I'll also be able to close this. Instead of clicking on File, New, before you come here with your mouse, a user can quickly use Control and N to create a new workbook. And again, another keyboard shortcut that are commonly used in Excel is to save a workbook. How do you save a workbook? So saving a workbook means that you use CTRL, that is CTRL plus S. So what does CTRL plus S do? It saves your workbook. So that is CTRL plus S. Instead of clicking on File, then Save, you can also be able to use CTRL plus S, or this one is also another way of saving. You just click here, you can see CTRL plus S visible on this particular area, CTRL plus S. So we want to try it, CTRL plus S. Remember, ours is already saved, so whatever we do, it will just be saving without changing the file name or giving an opportunity to change the file type or even the location. So a new workbook, Control and N. Now assuming you are saving this new workbook, remember this is book 1, this is book 5, and you are going to use Control and S, that is Control and S, it will take you here. You want to save this particular workbook. So that's a shortcut of saving as that. So we are not going to save that. That is a bit of the general shortcuts that are used in Excel. Of course, your main task is to make sure that you practice as much as possible on how to use those particular shortcuts. We are going to handle more shortcuts as we proceed with these particular classes. Bye for now, and see you in our next lesson.
August 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform.
Pricing. Look at question 3.
greetings to you all and welcome back to the platform. I'm glad to have you back. In today's lesson, I'm going to introduce the new topic known as the role of the governance professional in influencing boardroom dynamics. There are 6 subtopics. The first one being the 21st century governance professional. Number 2 is a strategic role of the corporate secretary. Number 3, application of theory. Number 4, influencing dynamics in a positive way. Number 5, leadership influence. And lastly, ethical dilemmas. Now, we first look at the 21st century governance professional. Now, candidates, the corporate secretary is the governance professional in an organization. And the corporate secretary, as the governance professional, is the person responsible for identifying what and advising why certain corporate governance best practices should be adopted by the organization, and that should be as a result of compliance with laws and so on. All right, they could be compliant with standards, compliance with codes, and that the reason being that the practices may make good operational sense for the organization. So it is the role of the governance professional, who is the corporate secretary, to identify and to advise the company why certain corporate governance best practices should be adopted by the organization. Then number 2, the corporate secretary, as a governance professional, is responsible for implementing within the organization those best practices through the creation and maintenance of culture and relationships. And that requires the corporate secretary to answer the how do we implement question, which requires corporate secretary to have emotional intelligence skills as well as technical skills. The third responsibility, candidates, is that the certified secretary is responsible for facilitating communication between board members, the board, and also the management, including the chairman, the chief executive officer, the company, the shareholders, and its stakeholders, the company's stakeholders. Facilitation of communication between all these stakeholders is the responsibility of the governance professional. And for corporate secretaries, as governance professionals, for them to carry out their role effectively, they should be commercially minded. They should be commercially aware. And that is an important feature of the job of a corporate secretary, especially because they advise the board on governance issues. And to be commercially aware, the corporate secretary must understand the business he or she operates in, or the business that the company operates in. And that is critical, because the corporate secretary cannot advise the board if he's not commercially minded, if he's not commercially aware, if he does or she does not understand the business the company operates in, the industry in which the company operates in, and so on. So we're discussing the 21st century governance professional. We've said in an organization, the corporate secretary is the governance professional, and he has various responsibilities, including identifying and advising the board on the best practices that the company should adopt. The 21st century governance professional. The corporate secretary must be commercially aware, must be commercially aware, must be commercially aware. And to be commercially aware, a corporate secretary should first of all understand how the organization makes money and how the organization creates value. Okay? That's a very important point. Should understand how the company creates value. Should understand how the company makes money, should understand how the company creates value. The corporate secretary should also understand what the company needs now and in the future. Understand what the company needs now and in future. Should understand what are the company's current needs, what are the company's potential needs in order to continue making money and creating value. The corporate secretary in the 21st century should also have thorough understanding of the company's competitive, thorough understanding of the company's competitive advantage. Should have a thorough understanding of the company's competitive advantage. We are discussing the role of the governance profession in the 21st century. The fourth point is that the corporate secretary should keep up to date with the industry. Keep up to date. The corporate secretary should be aware, should know what is happening in the industry within which the company operates. Should be aware with what we call the sector that the organization operates in. And therefore, for the corporate secretary to understand all these, corporate secretary is required to have certain skills. The skills. What skills should a corporate secretary have? Number one is active listening. Should be a good listener. A corporate secretary should be respectful, should be diplomatic, should have communication skills. A corporate secretary should be able to bring issues to the fore, issues to the surface, especially those relating to the reputation of the organization. Another skill is that one of being able to describe the common concerns and the interests of the company. While at the board, another point is that the corporate secretary should be able to help generate alternative solutions to the problem that the board faces. We also know that the corporate secretary is the custodian of the documents of the company, the instruments of the company. In that regard, therefore, the corporate secretary is expected to also respect confidences. Should be able to keep confidentiality of the information or the documents that he may come up or she may come across while discharging his or her functions as a corporate secretary. It is also expected that the corporate secretary should be able to disagree constructively. We've been discussing before about members having dissenting views. The corporate secretary may also disagree with the other board of directors. He or she is required to do so constructively. Then lastly, the corporate secretary should be one that emphasizes commercially minded approaches or solutions at the board. So we've done an introduction of this chapter, candidates. The chapter is on the role of the governance professional in the 21st century. We've come to the end of this lesson. If you have any question, please, you are free to send it. We continue to learn more as far as this topic is concerned. We'll be discussing more in relation to the strategic role of the corporate secretary. We will study the application of theory, how we study how the corporate secretary can influence dynamics in a positive way. We also consider the leadership influence and also the ethical dilemmas that the corporate secretary may face in the process of discharging his or her functions. Thank you. God bless you. Bye-bye.
of
That's 2022 sitting. So,
Hello learner, welcome to Manifested e-learning platform.
Pricing. Look at question 3.
greetings candidates and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today I'm going to answer question number 2, April 2022. Question 2A reads, during the last year's audit of Miller General Stores, a large retail chain of shops, you observe that commissions amount to about 25% of total sales, which is higher than in previous years. Further investigation reveals that the sector in which the shop operates on average has a larger sales commission than MGS, with significant variation in rates depending on the product sold. At the same time, a sale is made, the salesperson records his commission rate and the total amount of the commission on the office copy of the sales invoice. When sales are keyed into the computer, a debit to sales commission expense account and a credit to accrued sales commission account are also recorded. As part of recording the sales and sales commission expense, the accounts receivable clerk verifies the prices, quantities, commission rates, and all calculations on the sales invoices. Both the accounts receivable and salesperson commission master files are updated when the sales and sales commission are recorded. On the 15th day after the end of each month, the salesperson is paid for the preceding month's sales commission. Required Roman 1, an audit program to verify sales commission expense, assuming that no audit tests have been conducted in any audit area to this point. 6 marks. Roman 2, an audit program to verify accrued sales commission at the end of the year, assuming that the tests you designed in A1 above resulted in no significant misstatements. 6 marks. Question 2A, Roman 1. Audit program to verify sales commission expense. Audit program to verify sales commission expense. We have read, and I want you to go through the question one more time to understand the system of recording the sales commission expense. We read that when sales are keyed into the computer, a debit to sales commission expense account and a credit to accrued sales commission account are also recorded. Now, the first procedure, but before I get to the first procedure, candidates, the audit program documents the nature, the timing, and the extent of audit procedures to be performed at the assertion level for each material class of transactions or account balance and disclosure. And the program sets out the nature, the timing, and the extent of the audit procedures required to implement the overall plan, and it serves as a set of instructions to the engagement team and as a means to control and record the proper execution of audit. That's the meaning of an audit program. The question is, an audit program to verify sales expense, assuming that no audit tests have been conducted in any audit area to this point. The first point or instruction is to discuss the organization of sales commission function or the overall sales function. Discuss. I will do what? I will discuss the organization of the sales function. I'll discuss the organization of the sales function. The system of selling is a system. And that discussion will have to be with the management. Okay? With the management. And why should I, if I have to document this program, why should I discuss with the management? The purpose for discussing the organization of the sales function with management is so as to confirm the understanding of the sales process, in order to understand the sales process, in order to understand the direct or indirect methods that are used, as well as the controls over sales records that lead to commission calculations. Because calculation of commission is just an event. Before the calculation is calculated, it is important that there is understanding of the whole system up to the point of calculating of sales and up to the point of paying the agents. So the first step, discuss the organization of the sales function with the management in order to understand the sales process, in order to understand how the sales are made both directly and indirectly, and also the controls over the sales records that lead to commission calculations. The second point is to carry out validation or to validate the correct operation of formal procedures. Validate formal procedures like adding, deleting, adjusting. Okay? Validate the formal procedure or the correct operation of formal procedure to add, to delete, to change any employee records. Okay? Any employee records, including approval for commission plans and so on. And when validating this formal procedure, you also need to check the departed or relocated employees. For the departed or relocated employees, you should consider the timelines for sales commission payments and the account or customer transfer to subsequent sales representatives. So when an employee is transferred or when an employee is relocated elsewhere, it's important to check or consider the timelines of sales commission payments. When were their commissions paid? And what are the customers they are serving? What are the account numbers of the customers that you are serving? And the subsequent sales representatives, transfer to subsequent sales representatives. Because if I've been working in this department and I've been transferred to another department, while in the sales department, I used to serve certain customers. So when I leave, when I leave or when I depart, because I've been serving customers, I've been selling to customers in order to earn the commission. It's important to check the timelines for sales and also the account or customer transfer to subsequent sales representatives, which sales representatives takes over from the customers that I've been serving before I left. All right? Do you understand? Then point number 3 is in relation to the taxes on the commissions. You can check a sample of commission payments. Check sample of commission payments. Check a sample of commission payments for payroll taxes, for payroll. Check a sample of commission payments for payroll taxes, for deductions, and any other required adjustments. Okay, and then be sure commission payments with other payroll processing. There could also be deductions and so on. Number 4, review process for developing sales quotations. Review process for developing sales quotations. Now, candidates, if you understand the sales system, then these points becomes very easy, because there are times when quotations are received before the orders are processed and payments received from the customers when we are told the commissions. We read that at the time a sale is made, the salesperson records his commission rate and the total amount of the commission on the office copy of sales invoice. Office copy. But you see, at this point, we assume that the was a process of receiving the sales quotations. So it's important to review process for developing the sales quotations, because it's on the basis of the quotation that an order is. So it's important to review the process for developing the sales quotations. And while reviewing the process for developing the sales quotation, you may determine the procedure for recognizing and recording sales, and assess whether segregation of duties are adequate between the sales receivables and accounting in order to maintain control over sales records that generate commission payments. Assess whether segregation of duties. Assess whether segregation of duties. Now, when you say segregation of duties, it's important to understand that within the sales system, there are various functions that are carried out, like the receiving of quotations, processing of orders, making the payments, and so on. So it's important to assess segregation of duties, whether segregation of duties are adequate between the sales receivables are adequate between trade receivables. Trade receivables are debtors between the trade receivables and the accounting. And accounting, the purpose is just for maintaining control over sales records, all right? To maintain control over the sales records. Those who are maintaining the records should not be the ones processing the records. So that is a very important point. Then we may also select and review a sample of individual sales records to determine overall organization procedure are being followed from sales recognition through commissions calculated. Because remember, at the first stage, we say that the auditor should discuss the organization of the sales function with the management. The organization, how are sales made generally, from quotations to processing of orders to deliveries to the receiving of invoices to writing of the checks and so on. So when auditing, you may now select and review a sample of individual sales records. Select and review a sample of sales records. Why should you select and review a sample of the sales records? You do that in order to determine the overall procedure, to determine whether the overall procedure is followed from the sales recognition through to calculation of commissions. Number 7, discuss policies for allowing the discounts. Discuss policies for allowing for discounts or allowances, and also assess whether controls are operating effectively, so that you may also ensure transactions are compliant with policies and approvals, because sometimes discounts have to be approved. So you need to check and discuss policies for allowing for discounts. Discuss policies for allowing for discounts, for allowances, and assess whether policies or controls are being followed or are operating effectively. Evaluate the use of credit vouchers in the sales process. And why is it important to evaluate the use of credit vouchers in the sales process? That is important so that to determine adequate controls. To determine adequate controls like number sequencing, or sequence numbering, like approvals, like duplicates and so on. Number 9, consider the application of securities for sales. Consider the application security for sales, commissions, and product pricing data to determine appropriateness of the sales commission and so on. You can do that by checking segregation of duties, levels of authorization, commission calculations. You can also check supervisions, approvals, and so on. Then there are many points, candidates. You are expected to give 4, but you see I'm at the 8th point, so I'll stop at that. There are many points like reviewing, pricing. All right, there is, when you are reviewing pricing, you are looking at the expenses related to traveling, process, and reimbursing. All right. You can also check the policies for handling gifts to customers and so on. Part of the answer here could also be conducting a detailed analysis of sales. And when conducting detailed analysis of sales, you may compare sales by product. You may also compare product profitability and commissions paid out of sales personnel. You may determine if sales targets are accurately established for each product and whether actual sales are tracked against the targets. You may also assess whether proper sales commissions, calculations, or multipliers and formulas are used properly, because here calculations are paid. We read that at the same time the salesperson records his commission rate and the total amount of the commission on the office copy of the sale. So it's important to check if the calculations are done accurately. You can also determine whether controls are in place to ensure commissions and other compensation is accurate and consistent with the contracts. So there are many points that you can give when answering a question related to sales. All right, because here the examiner tested on audit program to verify sale commission expense. Sale commission expense. During the year, we would say this. We read that this is a large retail chain shop. It's a large. The MGS is a large retail chain of shops, and the commissions amount to about 25% of total sales. That's a big figure. It's almost a quarter. So that is part Roman 1 of this question. Now I want to answer part 2, which says an audit required an audit program to verify accrued sales commission at the end of the year, assuming that the test you designed in one above resulted in no significant misstatements. So an audit program to verify accrued sales commission. That is another account that we read from the question. We read that at the same time the salesperson records his commission rate at the total amount. Then when sales are keyed into the computer, a debit to sales commission expense and a credit to accrued sales commission account. There are two accounts, the sales commission expense and the accrued sales commission account. They are also recorded. Audit program to verify accrued sales commission. Now, since the information is keyed into the computer, the first thing to do as an auditor here is to download the sales data. Download the sales data. And this sales data should be for the period. And why should you download sales data for the period? To ensure information is reconciled to the general ledger. To ensure download sales data for the period to ensure information is reconciled to the general ledger. Then the second point or procedure is that you may want to select about 4 separate months of sales data. Select 3 or 4, just 3. You select out of the data that is downloaded. You then select separate 3 months of sales data. Select separate 3 months of sales data. And why do you need to select separate 3 months of sales data? You need to do that so that you can compare against sales returns or cancellation in the, say, 10th or 12 days of the following month in order to identify pipeline loading for sales compensation. You may also, after comparing, want to inquire about variances and the unusual activities. 3, you can match. You match the booked sales or sales booked. Match the sales. You match the sales booked per person. Match sales booked per person to sales returns. Because you downloaded all the sales data, you can now match the sales booked per person to sales returns. Then you can look for variances of high incidence rates. Then investigate unusual items or trends. 4, compare booked sales. You may also want to do what? To compare booked sales. And these are just the files. Within the downloaded data, you compare the booked sales file or files versus product pricing files versus product filing files. Compare booked sales file versus the product filing files. And why do you compare the two? You compare the two in order to assess compliance with approved price schedules. All right? In order to assess compliance with approved product prices. In order to assess compliance with the approved price schedules or product prices, then you can inquire about variances and evaluate approval of exception items. All right? Then 5, you have to give how many points here? You have to give 6. Number 5, you may review customer sale discounts. Review customer sale. Review customer sale discounts or rebates. Review customer sale discounts or rebates. You can also review the special pricing from sales files versus the standard discount rate versus standard discount rate, because a company will always have the standard discount rate. So you can review the discounts that are given to these customers and check if they are in line with the discount rates. Then if there is any variance, you also carry out investigation. 6, compare data of sales commission. We are discussing sales commission. Compare data of sales commission that is paid, because before it's accrued, then it is paid, of sales commission paid with sales receipts. Compare sales data of sales commission paid with sales receipts. And why is it important to compare? It's important to compare in order to determine if paid on timely basis. To determine if paid on timely basis. So these are 6 procedures. Here I gave you more than 10 procedures. 1, 2, 3, 4, 5, 6, 7, 8, 9, 8. Any 6 here would earn you the 6 marks. For part 2, audit program to verify accrued sales commission. 1, 2, 3, 4, 5, 6. 6 marks. That is April 2022 question 2A. Then question B reads, you are a newly appointed internal auditor of Zito Limited, a company that is currently experiencing financial difficulties. As a condition for obtaining bank loans, the company management has agreed to maintain certain liquidity ratios, asset to liquidity ratios, and gross profit margins. Second paragraph, the draft financial statements for the current period appear to show that the company has not succeeded in complying with some of the set targets. The profit figures are significantly affected by the calculation of bad debts and depreciation charges. There has been a suggestion to the effect that this could be changed in order to meet the bank's lending conditions. Third paragraph, you are informed that there is a real danger that if the bank withdraws its funding, the company would become insolvent and thus will have to cease trading. The chief accountant has asked you to sign certain internal records that have been altered in order to show the bank that the set targets have been met. Required, analyze the above scenario and explain the courses of action that you would take. 8 marks. Now this is a question testing on the question on integrity. And this question I will give you an opportunity to attempt first before I can do it. Please go and answer question 2A. Then you can take a picture of your answers, send your answers on the WhatsApp number that is appearing on your screen. Then later on, after I've seen what you've done, I will be able to answer the question. please attempt this question. It's a very important question that I would not want to impose my reason or my analysis on you. I want you to have a chance to attempt it first, then I'll give you my opinion as far as the question on integrity is concerned. I hope to meet you in our next session when we will answer question number 3. As I promised, we'll do all the questions that was tested in April 2022. Bye-bye. Greetings, candidates.
Yes, welcome again to our...
Welcome to Manifested On.
Welcome to Manifested E-Learning Forum.
Hello learners, and welcome again. In this session, we want to talk about data analysis, and more specifically using data tables in Excel. Of course, data tables in Excel are used alongside the what-if analysis kind of tasks. So welcome, and I believe that at the end of this session, you are going to be able to accomplish the specific items or the specific task that you are going to leave behind. And straight to data analysis using data tables in Excel. I'll open Excel and save it. Remember, this one is yet to be saved. I click on File, then I save. I'll give it a name. Let me just give it what if analysis. What if analysis. Then saved. Having done that, I'm going to rename this worksheet. Rename what if analysis. What if analysis. Of course, I love working with colors. We can have a color there. Then I'll have the selling price. I'm inputting some data here. Selling price. Then the selling price can be 100. Variable cost. The variable cost could be 55, and units sold. The unit sold could be 100,000. Then now we want to compute the contribution or gross profit. What if you want to get gross profit? Gross profit or contribution. Gross profit or contribution. Or maybe before I get gross profit, I could also get the sales revenue. Maybe sales revenue. And our sales revenue will be you take this, then you multiply with the selling price. And you get that. This becomes the sales revenue. You can reduce the number of zeros. 10 million there. Variable cost, of course, in shillings. This is variable cost. This is selling price per unit. Maybe I can per unit I can change a few things. This is variable cost per unit. This is revenue. Then the variable cost, of course, now all of it. So this will be equal sign. the unit sold, you multiply with the variable cost there, then you get that. Again, you can be able to, so your variable cost is that, then contribution or gross profit. Gross profit is the sales revenue minus what you see there. So that is sales revenue minus variable cost, total variable cost. Then you get 4,500,000. Fixed cost, which is constant. The fixed cost is at 2 million. 2 million. So that is fixed cost. Then profit. Net profit. And the net profit is now equal sign. Or before we, net profit is now the gross profit minus fixed cost. Then you'll be getting a net profit, let's say, of 2,500,000. So after that, I will make this to be big so that it's well visible that way. You can as well adjust your colors for better visibility. You can adjust your colors. Not a must that you adjust your colors. Now this is what we have, and we are going to use the what if analysis to be able to do a variety of things. What if this happens? What if you change the selling price? What if you change the variable cost? What if you do this? That is what we are going to do with the what if analysis, and in the process we are going also to see where the data tables will be applied in Excel. Now to access the what if analysis, for you to be able to access the what if analysis, you go to the data menu. Of course, there are so many menus here. The data menu, we have home, insert, page layout, formulas, then the data menu. Click on data. Once you click on data menu, there is a group for data tools. No, there's a group for forecasts. So under the group of forecast here, there are several groups like queries and connections, sort and filter, data tools. There is forecast. Now under the forecast group, there is what if analysis. We are going to use the what if analysis here. Click on what if analysis. Before we get there, what is what if analysis? You try out various values for the formulas in your sheet using scenario manager, goal seek, and data table. So you can see scenario manager, goal seek, and data tables. Scenario manager, goal seek, and data tables. So you try out various values for the formulas in your sheet using scenario manager, goal seek, and data tables. What if you change any of these? How will that impact profit? What if you change the selling price? What if you change the variable cost? What if you change the units sold? How will that impact the net profit? Let us start with the first one here, which is scenario manager. Now when using scenario manager, you can be able to create different groups of values or scenarios and switch between them. Of course, that is what the scenario manager will be doing. You'll be changing various variables here and see how that will impact profit. So we are going to click on scenario manager, and currently there is no scenario that has been added here. So you can see here scenarios, and no scenario is defined. You can choose to add. There is changing sales. There is also comment if you want to comment there. So I want to add a new scenario. You click on the scenario or you can cancel here, and you can see once you click on what if and you go to scenario manager, it gives you this. You can be able to add a new scenario. So click on add, and when you click on add, there is scenario name. Under scenario name, I want to say what if price is, what if that is selling price, what if selling price is 150. What if selling price is 150? What if selling price is 150? Now changing sales, you can see changing sales here. So the sale that I want to change is selling price. So what if selling price is 150? What if selling price is 150? So you click on that. And you can see the moment you click on 100 here, it takes the cell that is changing. That is the changing cell here. To can see some absolute cell referencing here, $B, $2. This is cell B2, cell B2, which will be changing. Comment, if you want a comment, of course you can do a comment. That is if you want. If you don't want, you can leave it like that. So a comment can be, what if, that is changing price, changing selling price. Remember, the comment is optional, to shillings 100, changing price to 100. Then click on OK and enter values for each of the changing cells. Enter values for each of the changing cells. We said we want to change this to 150. I believe it was 150. 150 like that. You can see OK. What if price selling or changing? Let me edit something here is wrong. What if selling price? It should be selling price. What if selling price is 150? What if selling price is 150? That is 150. Then you click on OK and you can see 150. Then you click on OK here. You can add another one if you want. So I want to add scenario name. What if price is changed to 200? What if price is changed to 200? Just price. Let me use another one. What if that is not price now? What if units sold? What if units sold change to 90,000? What if units sold change to 90,000? The changing cell is now this unit sold. So what if the unit sold change to that is 90,000? So I'll copy and I'll put the comment here. Then I'll click on OK. So we want 90,000. So it means you are changing that to 90,000. 90,000. I hope that is 90,000. No, that is 900,000. You can add another one. What if another scenario there, a scenario name. What if a selling price? What if selling price changes to 90? What if selling price changes to 90? So which is the changing cell? Selling price. What if it changes to 90? So I will copy the same thing here as my comment. So now the selling price to 90, we want it to move to 90. Then okay. Now we have those three particular scenarios, and we can be able to show what is happening, or we can be able to show the summary, or you can summarize, you can show, or you can do a lot of things. Now the first one, what if selling price is 150? What if selling price is 150? Let's see, just show. If selling price is 150, profit increases to 7,500,000. You can see it here. Now, what if selling price is 150, profit will increase to 7,500,000. Look at the unit sold. What if the unit sold changes to 90,000? If the unit sold changes to 90,000, what will happen to profit? Look at your profit. I'll click on show. So show. If that is to happen, then it means that the profit will now be at 6,550,000. That is if profit, or if the units to be sold are to change to 90,000. You can see the profit has moved. What if selling price changes to 90? You can see selling price changes to 90 here. So I'll click on it, then I'll select show. So what if the selling price changes to 90? So you can show here. and you can see the profit moves down now to 1,150,000. Now those are what you do in what if analysis using the scenario manager. That means you are just changing certain variables, and you see how will that make your profit to adjust, how will that affect the profit if things such as selling price are changed, variable cost are changed, or the unit sold is also changed. What if you want to show the summary? Remember, you can also show the summary of all those things by clicking on summary here, and we want scenario summary. Just click on OK, and you can be able to have this. So scenario summary is what we have here. Remember, a new worksheet was created. We have this and we have that. So we have this and we have that. So scenario summary, change in sales, current values. What if selling price is 150? What if unit sold is 90,000? What if selling price is 90? So those things will be changing as we progress there. Now see what is happening, and the profit was changing in this particular way. 1,150,000, 6,550,000, 1,150,000, if those values are to change. That's how you use the scenario manager to be able to analyze your data using what if analysis. The second thing that I want us to do, maybe we can take this back to how it was. Of course, this was 100. Then this one was 100,000. Yeah, 100 and 100,000, so that we are back at 2,500,000. These are the values that we had initially before this was changed to a variety of things here. So we are on what if analysis. Now we want to do data analysis again, but now using goal seek. Goal seek. That means if you want this amount of profit, if your target goal is to achieve this, if you are targeting to achieve this profit, then what will be the right value in terms of selling price, in terms of variable cost, or in terms of units sold to be used? So what if you target a profit of 3 million? Then how much selling price would you need? How many units do you need to sell for you to be able to get a profit of 3 million? That is the intention of goal seek. That means find the right input for the value you want. If you want a profit of 3 million, then how many units will be sold? Or what will be the selling price per unit? Or what will be the variable cost per unit? So that is the purpose of scenario of goal seek. So go to what if analysis and select goal seek, and select goal seek. So just select goal seek like that, goal seek. Once you have goal seek, we set a cell. We set a cell, and the cell that we are changing, of course, there is cell like the one that is selected now is D4. So you want profit, the value that you want. Which value do you want? I want 3 million. So I want 3 million. Now by changing cell, which cell are you changing? I want how many units will I sell to get a profit of 3 million? So I want